Hello everyone, welcome to SWBC's Uncharted Wealth Podcast. I'm your host, Chris Brigatti, Chief Investment Officer at SWBC, and this is episode 19.
Whoa. What are you doing, man? This is my show.
I thought I'd make it a little more interesting for everyone.
Hilarious. Hello and welcome to SWBC's Uncharted Wealth Podcast, where we explore the financial landscape and help you navigate your journey to and through retirement with confidence and clarity. I'm Mike Walters. I'm a certified financial planner and a wealth advisor here at SWBC, and today is going to be a great episode. We have Chief Investment Officer and kind of a local celebrity here at SWBC, Mr. Chris Brigatti. He's going to help us unpack 5 economic truths that pre-retirees and retirees should know heading into retirement. Chris, welcome to the show.
Thanks. Really glad to be here. Looking forward to this.
We're happy to have you, Chris. If you can kind of tell our audience a little bit about yourself and why you are just so important to us here at SWBC.
Well, as mentioned, I serve as the Chief Economist and Chief Investment Officer of the company, so I do a lot of discussions about the economy, what's going on with interest rates, anything from mortgages all the way to the equity market. So really kind of tried to add some value to our client base to let them know what's going on so they can make informed decisions.
And that's what we do here, is trying to help our audience make informed decisions when it comes to their retirement. Today's episode, we are going to talk about how to stay flexible in different economic cycles, what's changed in the retirement landscape just even over the past 5 to 10 years, and why your plan needs to evolve with the economy, not stay stagnant. So here we go. The first truth that we're going to talk about is that the economy is uncertain, but it's always been uncertain, okay? Retirement planning is about flexibility and making sure that you are not staying stagnant no matter what the economy is doing. The key is building a plan that works through volatility, not around it. So Chris, talking about how the economy has always been uncertain, can you give us a little bit of a historical perspective on why economic uncertainty is the norm, not the exception?
It's really an interesting question, interesting thought process to kind of work your way through. And when we talk about uncertainty in the economy, looking back historically speaking, there's always unknowns out there that occur in the market, in the environment, in the economy, geopolitical aspects. So there's all sorts of things that we kind of need to understand and know in order to develop more certainty. But the uncertainty right now is a little unprecedented in terms of the fact that there's more divisiveness within what can happen with the economy going forward. What do we expect for the next iteration of the economy? As indicated by the Federal Reserve, very wide divergence in their opinions right now, and that kind of adds to the overall level of uncertainty we're seeing.
Yeah, and not to mention that you're always going to see some gloom and doom headline in the news every day, it seems like. But if you look, I feel like if you look historically, it's the same headlines over and over again. So what about today's economic headlines should retirees think about in the context of long-term planning?
Well, one of the obvious things is what's going to happen next with the inflation picture. And that's one thing that we're really uncertain about right now. The Trump tariff situation has lent another layer of uncertainty to the market, which we haven't seen materialized yet in the data. So that is one of the things that I'm really most thoughtful of and aware of. Second thing is what's going on with the job picture. We have a cooling labor market, generally speaking. We've just seen some recent data that's kind of indicated that. And my questions are between those two competing almost narratives, which one will win or play out to a larger degree as we move forward.
Right, and just so when we're doing financial planning, there are always some key assumptions that we are working into the plans, with the biggest one being the inflation assumption. So just not knowing where we're going in the future with that can make or break a plan, I feel. And so making sure that you can stay flexible with that as you go through your retirement planning is very key. And speaking of interest rates, this is going to bring us to our second truth for today's episode, our interest rates, okay? Especially with the way interest rates have been higher over the last 5 years or so, they have kind of reshaped the fixed income landscape, especially speaking about with CDs and bonds. They're relevant again. Okay, I know previously in the past with some of my clients that have maybe been with me for a little while, we were shying away from CDs and bonds really just in general because the rates were not good, and you saw those falling market values just over the last 10 years. Like, it just was not profitable to hold bonds. Now, so Chris, can you tell us a little bit how our retirees can take advantage of the current fixed income landscape?
Great question. And one of the things that I'm very thoughtful of right now is we've come out of a period where we had a zero interest rate policy, otherwise known as ZIRP, from the Federal Reserve over a 10-year period. And that really led to a really unattractive environment for fixed income across the entire interest rate spectrum, across the entire interest rate curve. Now we're finally in a period where interest rates, as you mentioned, are really attractive. So investors are benefiting in a very notable way from a higher interest rate opportunity. And I would say it's a generational opportunity for investors to be able to participate, lock in high yields, very stable income streams, all the benefits that come with fixed income. And we're in an environment where they're going to benefit where they have not been able to for a very long period of time.
And speaking of more of a short-term strategy, the Federal Reserve has, I guess, started to lower their interest rates. So do you think right now is a key time for our fixed income investors to possibly jump back into these fixed income instruments, at least just to lock in some rates?
100% for certain. When the Fed begins an interest rate cutting cycle, which they have just started in the past month or so, that usually leads to a longer period of declining interest rates. And investors can benefit by locking in those high yields now before they continue to decline to lower levels. The Fed is doing it to stimulate the economy, which is going to drive some relative performance for fixed income instruments over a period of time. But for right now, to lock in these nice, attractive high yields, it's a great opportunity.
He basically said, let's go. That's what he just said. And I'm going to pause it here today and say, if you have not subscribed to the SWBC Uncharted Wealth podcast, now is your time. I'm not going to stare awkwardly at the camera today because I don't want to scare Chris off of the show, but subscribe, like, and comment. We love to see all the fresh new subscriber activity, but we'd also like to see some questions in the comments, or share it with your mother, brother, auntie, and cousin, or maybe even your best friend. Okay, so on to number 3. And for our third truth here is that flexibility is the new superpower when it comes to retirement. Now, a lot more retirees nowadays are maybe not working, like stopping work completely. They're actually working part-time, or they're picking up consulting gigs. I even had a client just a few weeks ago in our review meeting tell me that they got hit up by one of their old employers about doing some consulting work. And man, that changes the plan quite substantially, right? Because when you're on a fixed income and you're looking to see, hey, where's my income going to come from? Social Security benefits, pensions, so on and so forth. But now all of a sudden you have this new stream of income coming in. That can change a lot of things, right? And so many retirees are now choosing what's called a phased retirement. So they're maybe dropping down from full-time to part-time, and then maybe doing, seasonal work, whatever. Honestly, I think it's just because they're going crazy sitting at home by themselves. But that's just my opinion. But having that flexibility when it comes to their spending, what their income sources are going to be, and timing, I think is more valuable ever than it has ever been. And what I'm finding is that the most successful retirees nowadays aren't necessarily the ones that have the biggest portfolios. They're the ones that have that flexibility when it comes to choosing where their income comes from. Now, Chris, more of a personal question here. Obviously, this is his opinion, okay? But with the way that markets have been and the economy, and just knowing that, hey, flexibility is that new key superpower, does that make you feel more afraid of, retiring? Or does it make you, just like, hey, stay on the current course because I know there's going to be options out there?
Great question. When I think about this, my opinion, to be on point with that narrative, is I'm not very concerned for myself personally, but I think about what is the next step and what is the opportunity. And you brought up something really interesting that I've heard of a lot of people talk about that are entering that retirement phase. What can you do to kind of extend your career, extend some longevity? And that consulting kind of gig is a really interesting thing. A lot of people are taking advantage of it. As a retiree, you have a wealth of interest in terms of understanding what you've gone through, what you've dealt with in life, and you have experience that is invaluable. And to be able to use that and continue to use that going forward to help others is really interesting and important. So for my iteration, when I go to my retirement phase, I'm thoughtful about what will I do? Will I enter a consultancy phase? Hopefully, per SWBC, quite far away from that point yet. But when I do reach that, that could be an interesting gig for me.
And of course, he's going to be working with a financial advisor to help him maintain that flexibility.
Always.
Always. All right. Number 4, the fourth truth in today's episode is that your portfolio needs to be built for income, not just for growth. As I mentioned in previous episodes, I always think you have to need some type of allocation in your portfolio towards equities, stock market, okay, at least to pace with inflation. But shifting from accumulation during your working years to distribution when you actually start retiring and pulling that income, it requires a different investment mindset. So, Chris, tell us a little bit how, fixed income, dividend strategies, and like municipal bonds, right, for tax-free income, how can that support a predictable income plan in retirement?
The benefit of fixed income is in the name. It's a fixed income stream, and you know what it is. And the downside is that it can underperform versus inflation if inflation is a concern. But the upside is we're in a period that we mentioned previously where it's a good time to lock in some of these higher fixed income interest rates. And the other benefit of fixed income, it's a more stable, less volatile asset class. It generally doesn't have the high ups and big downs of the equity market, so you kind of can ride out a little bit more stability. Specifically talking about municipal bonds, a very high quality asset class. The tax-free income is key. Nobody likes to pay taxes. I've had clients that I've spoken to that will do anything to avoid paying a tax legally, of course, but the narrative is along the lines of what can they do to kind of benefit themselves, and having a nice, high quality, stable, tax-free income stream is really a plus.
And boy, would you know it, I talk about a lot of taxes on this podcast, and if somebody tells me tax-free income, I like to hear that. Boy, do I like to hear that. So, how should retirees think about generating income in today's market without taking on that unnecessary risk? Like you already mentioned that the fixed income market there tends to be a little bit less volatile, but are there any specific strategies that you recommend, like bond laddering or CDs, that would structure a portfolio to allow you to get that fixed income for long periods of time without taking on unnecessary risk?
Well, one of the things is making sure you have a balance in terms of diversification. Spread it out among asset classes within fixed income. Have different parts of the interest rate curve represented. And a nice ladder is always a very consistent stability type of approach for investors' income. And one of the things that I'm always thoughtful of is how can they benefit in the long run. Always have some cash to reinvest in the market. So having some of that short-term money to be able to take advantage of a backup in rates, an opportunity to perhaps throw a little bit more capital into an underperforming part of the interest rate curve is always a benefit.
Always have cash on the sidelines. You think about that for my clients that have a war chest or liquidity layer, like I've mentioned in the past, that cash is always going to be available there. And for our fifth and final truth for today is that inflation is not going anywhere, okay? It's going to be in the news all the time, but listen, it can be managed, and there are plenty of ways to manage inflation risk in your portfolio. A few different to name here is using real assets like, your house. It's usually one of the biggest assets in your portfolio, okay? Smart withdrawal planning from your different income sources, and something called TIPS, which stands for
Treasury Inflation Protected Securities.
There we go. There are actually securities out there that specifically hedge against inflation. And so if this is something that you're worried about long-term in your portfolio, it might be smart to include them as an inflation hedge. So Chris, can you share your outlook on inflation, at least over the next few years, just to help our retirees prepare?
One of the things that we were very thoughtful about heading into the beginning of this year was what would be the impact of President Trump's policies on inflation. And initially there was concern that his tariffs and the tariff initiatives would be very inflationary and impact the market a lot. We haven't seen it flow through to the data yet. It really hasn't fully materialized. We're starting to see a little bit of an uptick of late to some service sectors of the economy, but generally speaking, it's kind of held off. So we're in this somewhere around 3% inflation environment. The Federal Reserve wants us to get down to about a 2%. That's going to take a little bit of work. And with the rate cutting environment, it makes it a little harder to happen. So we could be in an extended period of slightly higher than desirable inflation. So somewhere in the 3% range is probably going to be the norm for the foreseeable future.
Yeah, and again, just to harp on this, inflation is not going away. It is always going to be here. Don't be a silly goose and think that you're just, always going to have to deal with inflation, or it's going to be high, or it costs too much to buy eggs, or people are going to go to the grocery store and start buying up toilet paper like crazy. But listen, inflation is not going anywhere. Just like Chris said, it's probably going to be a little bit higher in the future, right? But there are ways to manage it. So let's move on to the uncharted territory of today's episode. All right, for the uncharted territory of today's episode, we are going to be talking about retirement flex framework, okay? It's a simple framework to kind of help you stay flexible in retirement. So the first of three things is, one, layering your income. This means blending your guaranteed income sources like Social Security or pensions with flexible withdrawals, okay, knowing which account to pull from and when, and also maybe working in some part-time work, just doing some consulting or something, right? The second part, liquidity layers / war chest. Look, I'm gonna beat it over every single episode talking about something like this, is you need to have some type of war chest of 3 to 5 years of really safe, really stable investments to draw from income, right? Having this liquidity layer is going to give you that accessibility to cash and other investments that you can draw from for income if the markets were to tank, right? Or if we see some key opportunities in the fixed income market, maybe we deploy it, right? It just gives us that flexibility because that's what we're aiming for. And the last thing here is your growth bucket, okay? Separating your war chest from your growth bucket is essential. Your growth bucket is your portion of the portfolio that is always going to be invested in some type of growth aspect, whether it's real estate, whether it's tech stocks, whatever. Not making a recommendation, just talking in general terms. But this is going to help you hedge against that long-term inflation protection. Because remember, retirement is not a fixed destination, it's a moving target. So using this retirement flex framework is going to help you stay nimble no matter what the market throws at us. And the market tends to throw us some nasty things sometimes.
There's a lot of curveballs out there, so you got to be ready to hit them out of the park when you can.
That's a good one. We should use that next time. All right, so for the key takeaway that I want to remind our listeners to is that retirement is not canceled, okay? But it does look different than it has in the past. If you're willing to adapt, stay informed, and be flexible to today's realities, then retirement can still look good for you. Now, I'm going to encourage everyone to revisit your retirement plan and your income strategy. See if there's any moves that you can be making with the current fixed income market to possibly lower your risk and secure some of these good rates that are still available. Also, talk with an advisor, like Chris is doing. He's talking with an advisor.
Always have to talk to the advisors.
Talk with a professional to see if your retirement plan is still on track and how rising rates and inflation can either throw off your plan or maybe improve it over time. And the last thing is to just consider how flexibility in retirement, both financial and lifestyle flexibility, can be built in your own retirement vision. So, if you're within 10 years of retirement and you would like to see how rising interest rates, inflation, or different income strategies is going to affect your personal retirement plan, please give us a call. Our information is going to be at the bottom of this screen. Yes, it's going to be at the bottom of the screen this time with our email. So give us a contact if you would like to talk with an advisor. Chris, I want to thank you for joining us today. It's been fun. It's been real. It's been really fun, actually, for those of you who know. But we're probably going to have you on in a future episode just because I like the idea of having current stuff to our audience. So thank you for being here and appreciate your time.
I'm glad to participate. This was a lot of fun.
So that brings us to our disclosures, which is probably my favorite part. Nothing that we talked about today should be taken as financial advice, tax advice, or legal advice. And anything that Chris and I discussed today is our opinions, not the opinions of SWBC or its executives. So remember to like, comment, and subscribe. You want to share this with your cousin, your brother, your auntie, your stepbrother, and your best friend. And we'll see you on the next episode of Uncharted Wealth. Peace.
definitely have that in the end, the bloopers. Yes, right.
That one caught me off guard.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.